Welcome to the Broken Pie Chart Podcast, episode 390. I'm your host, Derek Moore. Back with me again, Mike Snyder, Shane Skinner. All right, kind of random. We're recording this on a Monday just because of scheduling, but it's still a lot going on. So the forward PE of the largest 10 companies, this is according to JP Morgan and Mike Zaccardi, the forward PE of the largest 10 companies in the S&P 500 has converged to that of the remaining companies. So they have a chart in here. This chart, it looks like it's from JP Morgan's Guide to the Markets. The top 10 companies, latest 19.8 times forward. The remaining companies, 19.3. The S&P, 19.6. So, and you look at the chart, the top 10 companies they make this case. They're like, 1999, look at how far away the top 10 companies were. Of course, that came down because you had the tech crash. So it was the market coming down and those companies especially being pummeled. What's interesting here is, we've had these companies continue to go higher, although they're not at all-time highs necessarily, like if we look at the mags. But the earnings have gone up at a higher rate, at a faster rate than the price has. So you've seen the forward PE, the valuations come down. So I don't know, like Shane, when I look at this is actually telling me that you remember what everyone was up in arms about, like it's the top 10 companies, that's all that matters. Like they're all sort of converging now. Like you're getting a broadening of the market here.
Yeah, I think we've been saying for a couple of weeks now, like, is this turning into a stock picker's market? Are you getting a decoupling where, in the early 2020s and up until now, it's still held pretty strong. You've seen some of the largest cross-asset correlation across all different asset classes in the market. And, in some ways, if you've just been long assets, you've probably been pretty happy, right? Because in general, assets have been trending up and to the right, at least in, the equity space and, even some commodities, stuff like that. But, this is where it kind of like, you almost have to, if you're going to try to pick stocks, like this is your window, right? You're all of a sudden, you might see one name going up in the same sector or industry that another isn't. And so it'll be interesting to watch it from the sector level, but not just there, but the individual names who comes out sort of leading the second half of this year.
Ben Carlson had a tweet out and he said, since the start of 2025, the tech sector is up 65%. In that time, the forward PE ratio has fallen from 29 times he has 22 times. And some people will say, well, why did the one you just read was 19.6? This one's 22. Well, this is just tech stocks. But yeah, he's got a chart here. And you look at the 5-year average, the 10-year average, we're below both of those right now. And I think this kind of speaks that the tech portion has not really, it hasn't gone up as much as some of the other stuff. But at the same time, their earnings are at a much higher rate. Like, Mike, we're seeing technology, earnings estimates are going up. At the same time, CapEx is going up. And yeah, like even we were talking this morning, what are we at? A little over 20 on the forward, the general S&P 500. So this is a case where it's not like the market's going higher, is a function of earnings estimates going higher.
Yeah, I think, the PE, like you said, it was 29 and it fell to 22 and now it's just below 22. And tech had a really nice run. And now the question is, what does CapEx and spending look like 2-3+ years down the road? And I think maybe that's why we're at the valuation we're at.
But doesn't this like kill the argument that this is March of 2000? Like March of 2000 was stocks, the multiple keeps going higher and higher and higher, despite earnings not going higher. Like this sort of is a different market, right?
Completely different. I mean, you can question what sales and CapEx look like in 2 years, but what's totally different is that the market's actually getting cheaper while it moves higher because earnings are so strong. So when companies are reporting, what they're reporting is they're reporting strong numbers and earnings continue to go up. the market's gone up, but not at the same rate as the earnings are growing, actually, when you look at what that PE was to where it is now.
Yeah, I mean, and margins continue to be higher. I think we looked this morning, the estimates by the analyst, about 16.5 forward net profit margins. They've gone up every decade. I mean, that's no surprise looking at the types of companies that are in there. And I mean, maybe people are bored with just buying stocks that seemingly have gone up pretty nicely for people. And the reason why I say that, Eric Baltunas pointed out, and he actually retweeted something from Jeffrey Patak, who said, wild, wild stuff. Filing to register 32 ETFs tied to each NHL franchise. Okay, I have a lot of comments on this. Let me read this, though. Each ETF will invest in futures contracts tied to the CME FSPI index, wherever the heck FSPI stands for the team concerned. The index measures cumulative team performance. And he gives sort of an example. But I did a little AI sleuthing on this, and it seems like you can't really tell what the statistical measures are. But according to the search, the SEC filing confirms that each team index is based on 55 statistical measures of performance plus game results, wins, losses, and ties. The filing does not provide the 55 item list or their individual weights. All right. So, and by the way, the Florida Panthers were a public team or a public company. Was it 94? Might have been 94 or 95. The symbol was PUCK, P-U-C-K. And you could have bought shares in the Florida Panthers. I think it since went private, or I didn't do the research to find out exactly what happened. So my first thought is, why? Are we this bored that this needs to happen? I don't know the methodology. It sounds like there's an index, and then when stuff happens, the index goes up or down, and it's more than just wins and losses. I don't know. We'll see when more comes out of this. It also doesn't say, so for example, anyone who doesn't know hockey, so if we say, okay, like the Florida Panthers or Edmonton Oilers or, but I think the Panthers or Carolina Hurricanes, last year's champion, there's some of the teams that are sort of favored to be good contenders for the Stanley Cup, to win the championship, for anyone who doesn't know hockey. And teams like maybe, I don't know, the Florida Panthers, not Florida, Calgary Flames, or I don't know, Columbus Blue Jackets. Pick a team that's not expected to do this well. Mike, you are a former high school hockey star, right? So this is really your wheelhouse. You played high school hockey. So I don't know how these will work yet, but are you telling me these are all going to come out at the same price and they'll just go up or down based upon what people think? I guess you can short these too. So maybe a team, mid-season has some injuries and you can short them. Is this where we've gone here?
Yeah, I guess people are that bored, and betting. Even though I don't know that this is technically betting. It's more fantasy sports, which I guess the government looks at differently, because it's not actually someone betting on the Anaheim Ducks winning a specific game. It's based on a number of different metrics, it sounds like. So this is fantasy sports in market form, in liquid market form. I guess that's what they're saying is the benefit of it. Yeah, I don't know as far as how they're going to trade, what price they're going to come out at. I don't know if there's a par value, and then the teams that are expected to perform worse trade lower than that. If they all come out at the same price, then you see a bunch of shorting on the worst teams. I can't imagine that that's how it works. So I'm curious to know that plan.
I mean, I don't know why. I get why some brokerage firms probably will get into prediction markets, but I'll be honest with you. There's no long-term benefit to this. I'm sorry. There just isn't. And I think people are going to lose money on this. I don't know who's buying these ETFs. I'm going to be really curious to see. This is, I guess, volatility shares. I need to know more about how they work, but this is essentially betting. Like, I don't think this is good. Like, I don't get it. Shane?
I don't know how the SEC is approving it. That's where I don't understand it. I mean, I'm very much a fan of free markets, and it's not volatility shares' fault that this is something that it seems like is being allowed to happen. And at the end of the day, I mean, the old famous, like, why'd you do it? Well, because I could, right? And look, if there's a product out there that could be, effectively, they could take away some of the market share that exists in other venues and areas. I'll blame, and I don't want to actually say I blame anybody, but I believe Robinhood, you can do it now at Robinhood. You can do event contracts on sports. And so where I'm going with that is, once you allow a brokerage like Robinhood to start offering things like event contracts tied to sports, it doesn't surprise me that other players within the brokerage related space are trying to come up with other products to maybe take away part of that market share. So, like, on one hand, I tip my hat to volatility shares for going for this. And then on the other hand, I am scared of the precedent that this is setting for ETFs. Because when I think of an ETF, I don't think of this, and I think you guys agree.
Yeah, like, the fascinating thing is kind of shorting these. So you think about a team that I'm trying to come up with an example. Like, let's say the Indianapolis Colts. I assume they're going to do this with the NFL too. I don't know. I mean, the only tweet I saw was about the NHL ones. But the Colts last year lost their quarterback, Daniel Jones, with a season-ending injury. So in theory, somebody could have shorted that ETF. I imagine it would have went down, or maybe not. Well, I guess if negative things can push it down, I don't know. I live in Arizona, and there is, I believe Arizona is suing, is it the CFTC? It might be against I don't know, but I might actually be against Kalshi. And the thing that's happening is, when I read this locally, their premise is, look, I mean, we already have gaming compacts with different Native American reservations. There's specific, there's the online companies are here, like FanDuel and MGM and all those, but they have compacts set up with the states. So they share revenue in certain ways, and the state sort of controls who can do what. And I think Arizona is saying, well, wait a second. No, this violates local law. And I believe that, I have no idea where the lawsuit is, but one of the things people reported locally here is that it's a question of federal law versus local law and who trumps what. So I don't know. And I'm not sure. Like, does Arizona say, well, wait a second. No, you're doing these to get around. I mean, we want a piece of this, because I'm not sure.
That's a good point, though. I hadn't thought of that, because this is this is way to get similar exposure to what otherwise would have to go through that, right?
Yeah, and I haven't seen anything that's, maybe the prediction markets are doing game by game, but this sounds like it's going to be, like Mike said, it's more of like a fantasy sports, the old roto sports, where it's a season long and you have this cumulative stats that build up. I mean, are they going to get enough money in these to make money? I guess. So that will be interesting too. I mean, there's 32 NHL teams. I guess, I mean, you need enough of these to get assets into it to carry the ones that are, still costing you to have open. I don't know.
Right. Like, who's going to buy? I mean, I'm sure people will, but like, who's going to buy the teams that are expected to perform the worst?
You're
they're going to have to be discounted significantly, I guess.
Hey. The St. Louis Blues, at the halfway point of the season that they won the cup, were the worst ranked team in the league when they pulled that off. Now, that's like, I don't know if that's even ever happened before and since.
But would you buy? So here's the thing. Like,
no.
Let's say they're all the same price when they launch.
Okay.
And it's a cumulative thing. Like, in theory, the expectation should mean that if you don't think the Blues are going to be good, they should be at a discount to the Florida Panthers or the Carolina Hurricanes, who are expected to be good. I mean,
I'll sell the Blues and I'll go use the funds to buy the Panthers. Yeah, absolutely. You do like can you pairs trade these?
I guess you could, but I just don't know where they're going to start at. There's not enough info out. It looks like, I mean, this is the first I'm reading about it. It's a filing. Okay. So I don't know.
What if they do options? I mean, who knows? But I could see it if these stick.
Yeah, I just think about it because if you come out with 32 ETFs, there is a cost for each of those. And I mean, what you're doing for one, you could, I mean, I've been involved in, prospectuses for some of these things in a prior sort of time. And yeah, like you do these prospectuses, but in theory, you could just change the name from like the Anaheim Ducks to the Florida Panthers and use sort of the same stuff. So yeah, I don't know. I don't know what their cost is for each of these. But generally, depending upon what the fee, I mean, that's the other thing. We don't know the fees on these. So, there's like a break even asset level. And if you're under that, you don't make money, but you put a lot of these out and maybe, I don't know. I'm just curious about, I don't get it, but maybe these will be huge and there'll be billions of dollars in these. And I'll look like a clown for saying there's no way these are going to be successful, but I don't know. Okay. Can we move on from this? And we're not talking about Sailor or Bitcoin this week, but, all right. Bespoke had something out that, these charts, sometimes I say, well, you can't really do this. And other times I'm like, it's kind of tracing pretty good. They did a chart from December of 94 through December of 04. And they had a chart of Netscape, the price of Netscape. So for any of you who are younger, Netscape was sort of the original browser. And was it Netscape Navigator? I think that was the name. It IPO'd. I think it IPO'd in the 20s, somewhere in the 20s. It traded up like, I don't know. First trade was in the 70s. I mean, it looks like in March of 2000, it got up to $592. Netscape, by the way, in theory, it became obsolete because, as everybody knows, Google took over. But the audience can't see this. The chart they showed was Netscape release was 12/19/94. Oh, sorry. No, that's 592 was the NASDAQ composite. Scratch that. All right. So anyway, Netscape 12/19/94 through 929 days. Let me see. The NASDAQ composite was up 146%. Okay. That's the comparison they're making here. And then they say, well, ChatGPT was released 11/30 of 22. And through 929 days, it's up 144%. So you see where they're going here, that you have these two. ChatGPT, okay, let me clean this up. ChatGPT gets released to the current day, and they did Netscape from its release to the same point in time of ChatGPT, and they're saying the NASDAQ was up basically about 145%. And then if you go on in this chart, you kind of look and you say, well, actually, at one point, the NASDAQ 100 at the high of March 10th, 2000 was up 592%. And then, of course, the tech crash and the boom. So, Mike, I think Bespoke is trying to say that, I don't know, we're going to surge to going to go parabolic and then we're going to crash down. Is that what they're trying to say here?
Yeah, that's, if the chart follows, that's what they're saying. But yeah, I mean, it's an indicator of, in the early 90s, we're on the cusp of the internet and that revolutionizing everything. And ChatGPT, coming out in 2022 seems like we're on the cusp of another, technological revolution. And so comparing how the index is done since both of those sort of landmark products came out, the NASDAQ has performed almost identically. But it's not telling nearly all of the story, of course. There's, it's not telling you that a lot of the companies, when Netscape came out, were being bought with no earnings or negative earnings. Whereas today, as we just talked about, these companies are profitable. So the charts look similar, but the environment and the story is very different.
I mean, if you wanted to tell a story, or if you had an opinion, you would look for something like this to show people. You would say, look, it's tracing exactly the same. They're convincing. And if I wanted to show something else, I'd probably show a chart of like the forward PE ratios and say,
Right.
oh, look, it's not really the same. Interesting thing on Netscape, though. So Netscape, I remember the IPO, and yeah, I mean, like nobody was buying it. There were no shares available in the 20s, but I think it was the 95. I think it was 95 that it IPO'd. And so let's say you bought it, maybe you didn't buy it at like, in the 20s, you bought it at the first price, which is in the 70s. So then you say, did you actually make money? Well, it's tough to tell because one, the stock isn't around anymore, because I believe, was it AOL that bought them? So I think AOL bought Netscape, and I'm trying to look and see what the timing was. Yeah, I don't remember exactly, but AOL bought Netscape, and then Time Warner buys AOL, and then Time Warner. So I guess if you had Netscape, now you have Time Warner shares. And then didn't they do a spinoff or Charter? Did they buy Charter? So, then I think they spun off AOL. They spun off, like, was it Time? Time was like the media. So anyway, I think all that to say, like if you actually bought Netscape and then you held through today, I think you have Time Warner shares or AT&T shares maybe. I don't even know, and it's irrelevant. But the point is, like, I do wonder too. Like I've had this question: is ChatGPT or one of these, Anthropic, are they the Netscape? Like, is there something else that's coming out? Is it actually Grok? Like Grok's the thing that all of a sudden leapfrogs everybody, which of course is part of XAI, but
it hasn't come out yet. Whatever's going to do it hasn't come out yet. Just like Google didn't come out for almost, a decade, it looks like on this chart. This blows my mind too, that like you look at how many drawdowns occurred going up into this. I wasn't obviously around for this. I was born in August of 97 there, Derek. So, you caught a nice bounce right around when I was born. You guys are welcome for that. But I mean, look at what happened after the fact, and who knows where the market's about to go. But if I'm looking at this, and I think history often repeats, sometimes rhymes, or often rhymes, sometimes repeats, I look at this and I think we're probably at a fork in the road here. And, if it's going to follow this fractal, there's a lot of upside here potentially. And if it's not, then this has failed. But up until this point, this is a very clean fractal.
Google didn't go public until the early 2000s, but they were around in the late 90s, but it wasn't like 94, 95 was kind of the first wave. I think Google came out, it's either 98 or 99. But Cameron Dawson had said this. I was at the CFA Phoenix dinner, and she had made mention it was either the 7th or the 17th web browser to come out, Google, and it wound up being the winner. So, yeah, I do wonder, and if I'm picking right now, and this is just a guess, I don't know if ChatGPT is the one. It seems like Claude is, people are using that. They have that software that Claude integrates. And Grok, I guess, just really, they did the Cursor acquisition, and they have Grokbot now. But like you said, Shane, like something else might come out. We don't even know. The barrier to entry is the compute. And, that's a big expense. Like, Mike, the other reason, we'll see which one of these is the winner. But, Mike, don't you think, like, part of this is they call it regulatory capture? So you have some people who are in the markets, and they go to the government and they say, we need ground rules and we need laws, and that actually entrenches the incumbents because it makes the entry cost or the barriers much higher.
Yeah, I think you saw Meta kind of do that too. They were encouraging more regulation, and it wasn't because they're just good people. It was because, they realize that makes it that much harder to get into that business. So yeah, certainly I think that's part of it, and that creates obstacles for new entrants. If
didn't Meta say, Mike, that we think you should regulate us and we'll help you write the regulations?
Yeah, I'm pretty sure exactly how that went.
All right. So think about what the markets are. This is from Macro Charts. And the title of it is Biggest NASDAQ Short of All Time. So with futures, there is, there's sort of this, you measure the commitment of traders report, and you can look at commercials, you can look at hedgers. So according to this chart, all right, well, this goes back only to 2020. So is this really the most ever? Anyway, I'll deal with that later. And yeah, there's a lot of people short NDX 100 futures right now. The thing is, though, you never know why that is. Like, they could be really bulled up, but they're using this as a way to hedge some of the position, or
could be market makers. Could be. Is this commodity trading advisors? Is this CTAs possibly?
Well, it's not really. It's not clear.
It says
asset managers and hedge funds. So there you go.
So asset managers.
But normally, if you're that short, it's, the contrarian says that could be bullish too. I don't know.
Yeah, short squeezing is a technical
sort of way to look at the market for a reason. Those sellers have to become buyers eventually, right?
Yeah. The other way to look at this is maybe some of the funds or the asset managers have high embedded capital gains, and they're like, well, we've got a portfolio of stocks, we'll short using NDX futures. Yeah, we'll offset it a little bit. I don't know. It was just noticeable. Is this really all time? Like, they're showing me a chart, record short, but it only goes back to 2020. I might throw a flag on this one. Like, you got to give me more info here. All right, let's move on. Demand for gold. Flows into gold funds, 4-week moving average. Not surprising, gold kind of is based out a little bit and is turning higher. We sort of been looking at the charts on gold, and it wouldn't surprise me, Shane, if it caught a bid here. I don't know, though, are people re-engaging the old trend? Sometimes something breaks down and then people forget about it. But flows are coming back in. And the flows, they're not as high as they were in February of this year or, October or November of last year. But people are buying gold again.
Yeah, it's kind of beautiful if you look at a 52-week chart of gold, or GLD here, the Spider Gold Shares ETF. Mm-hmm. The low of the past 52 weeks was almost exactly 52 weeks ago, and it was a low of 305.19. High, that was in, again, last August. Okay, the high of the past 52 weeks came in January of this year at 509.70. So about a $204 increase off 305, about a 66% increase from the 52-week low to the 52-week high there. Since then, we've basically traded sideways between 360 and 425. And I'm wondering if you're right, like it's basing. And sometimes with commodities, I think people get really caught up in, they're either trending up or they are trending down. And this one seems to be sort of sitting right in the middle of the range that was established after the big bull run from last year into the beginning of this year. And so we might see another bid in here. And I think it's worth considering watching commodities in general across the board. They're all kind of looking the same here, aren't they? Kind of looks like oil a little bit too, chart wise.
Yeah, oil is one of those that, even on the show, I think I said, yeah, it's done. Like, that move's over. But the shenanigans are not done and oil is catching a bid again. I know, Mike, we've been talking about some of the stocks. We noticed Exxon is kind of breaking out a little bit from its recent sideways slop, right? Is this a case? Are we concerned yet? Are we concerned with these oil prices?
I don't think we're too concerned with the oil prices. I think it's interesting to see energy stocks they've been moving higher even when oil hasn't. Through the oil spike that we saw in March, you saw energy stocks sort of move exactly with that. And oil's come back a bit, but I would say that even on down days or when oil's been trending lower, we've seen energy stocks having ticked higher. And getting back to gold, we've seen the dollar soften a bit, which may be a reason for that little tick higher that we've seen in gold recently. There's more geopolitical uncertainty, which may also be a factor. And of course, now the Fed just went from probably raising to probably not raising in September, which obviously plays a factor in the dollar. But I think all of that is helping gold move higher here.
There is an argument, though, Mike, that people are making. I think James Bullard, the former Fed chair, was making the argument, yeah, you should raise rates now. Why wait until the economy softens? Mike, I've said this time and time again, like, you can't tell me that raising rates will do anything for the price of energy. Like, I'm sorry.
No, I don't think it will. I'm with you. It's not a demand thing, like we've said. It's strictly been a supply issue. So raising rates is not going to all of a sudden create a flood of oil that is going to help lower the price.
Yeah, I mean, if you want to fix the price of oil, you either have to get more, so more supply, like the cure for high oil prices or high oil prices, as they say, or you need to figure out how to fix the supply stuff. I mean, to me, this almost will force some sort of alternative pipeline, because if they're closing the Strait of Hormuz, my guess is they're going to be like, maybe we should finally do that pipeline to the other side or to the south of some of those countries, and it might be worth it. So, yeah,
it's crazy to think though. Like this really has like significant impact to like you were just saying, like pipelines, trade routes, like trade agreements, things like that. Who's going to get their energy where and how? And I mean, I think Derek, didn't you say that like the oil from Venezuela, like there's a lot of, I keep hearing how they've got the largest deposit and like we could see a ton of output coming from there in the future, but isn't it a completely different refining process and like quality of oil and everything too? So it's not like this is just something where you can just necessarily start getting the exact same output from a place that's been shut off somewhere else. It's got different quality of oil.
Yeah, it's light sweet. Some of the stuff is thicker and it's harder to refine, and that's kind of some of those differences. I mean, but Venezuela coming online definitely helps, and I mean any of the oil coming online helps. They just have to figure out. I mean, there's some strategy here where I think they found a pain point where they can tie this up. I don't know. I mean, you also look at VIX seasonality, and we're coming out of usually August and September. Yeah, I mean August, where we are right now, it's usually kind of a low point in seasonal volatility. Typically what happens, and this is from 1990 to 2025, this is from top-down charts and LSEG. The average SIBO VIX, 1990 to 2025, and then excluding 08 and 20. So there's a bunch of lines on the chart. And basically what you see, you're not looking at the chart, we are. No surprise, October into November, you see volatility spike. And this is an average over over 35 years. but we're coming into more of an average daily level of higher VIX seasonality. So, I mean, maybe that's one of the reasons why we're seeing gold get a bid. I don't know. Mike, you mentioned the dollar was soft a little bit. I mean, it's below 100 now. But yeah, I mean, like, Mike, this wouldn't surprise me if we had something. And here's the thing, like, the most obvious stuff to cause a problem are known right now, but it's always something that nobody's looking at that causes a problem here. So
yeah, it's usually the unknown that comes out of nowhere that causes the VIX to really spike. I mean, because otherwise, you know, the known issues out there, everyone knows about what they potentially could do. And if the market really cared about them that much, the VIX would be higher. And, you know, the VIX, it also could just trade at this level for a while. I mean, we've seen it where it feels like, okay, the VIX has to go higher, and eventually it does. But sometimes it stays here for months before it does, before that
2017.
event.
I mean, that was it 17 when the VIX hit sub 10, I think. So, yeah, like a low VIX doesn't necessarily mean you get a high VIX.
It usually means eventually you do. It's just a matter of when.
Yeah, I mean, we watch some of this stuff. We run a quant strategy that involves different volatility measures, and sometimes, yeah, just because it's low doesn't mean. But there's other things that in a sequence that actually tell you a little bit more about when it's going to be higher. You know, Shane, you brought up 30-year yields or yields in general. I would argue that 5.3% 30-year yield is nothing that's not that high.
I'm happy about it. Shouldn't you get more money? Like,
a good friend of mine and I, since college, have been making the argument that, like, the curve needs to steepen. You should be getting more on a 30-year bond than you get on a 20, than you get on a 10, than you get on a 5, and it shouldn't even be close, in my opinion. What you're getting, that to me is a healthy bond market. And so I don't think these spikes on the back end are a bad thing. I think the steepening out's good, and I think it might steepen even more if they end up cutting, which anybody who's ruling out a cut, I think they need to really rethink why this Fed chair and why this Federal Reserve wouldn't consider a cut at some point, because I'm going to sound like you, Derek. I mean, we had interest rates for a very long time. Fed funds rates were, right? And inflation, it wasn't a problem with inflation. It didn't cause issues. And I'd make the argument that inflation, if you're worried about food prices going up, if you're worried about energy going up, higher rates isn't going to fix that problem. Everybody's still going to need food and energy. That demand isn't going to go away. So, you know, I just think it's funny. Mike mentioned how, like, the rate hike is now sort of out of the picture for September. Maybe we don't get a rate cut then, but could you see a rate cut this year, especially if maybe the market does get a little more volatile into the fall, and maybe we see a little bit more unemployment increase? Maybe they say, hey, we're going to try to help out the job market and cut rates.
I mean, they could make that argument, but I also warn people who are rooting for lower rates, be careful what you wish for, because if they are substantially lowering rates, there's some upset in the markets. I also go back to the 90s. In the 1990s, we had Fed funds that were higher than this, you know, as a constant, and the markets were just fine. Like, the markets, I know lower rates are better for the markets. Obviously, if you do a discounted cash flow, or you do you discount the future earnings to the present, all that stuff, the higher the discount rate, the lower the value pulled forward from the future. But I mean, markets did okay with higher rates. And I don't disagree, Shane. If you're giving your money to somebody for 30 years, I want to get paid for it. And the idea that somebody could take your money for 30 years, I mean, you have real risk in a 30-year bond. You have real risk because if interest rates go up, the math says the longer time to maturity, the more your risk is. I mean, if you bought rates aren't, 0.75 on the 30-year anymore. But if you bought one of those, you're not getting above water, above break even for a long time on that. It's a different world today because the sensitivity to rates is a combination of that time to maturity, but also the interest rate. So the higher the interest rate, the starting rate is, it does dampen the risk a little bit, but not substantially. I mean, Mike, I think some people who want lower rates are also talking their book. So by talking their book, are you in real estate? Are you in that business? Do you hold bonds? Are you underwater on bonds? Like, to me, I'm okay with a little bit of higher rate on the back end.
Yeah, I think the number one, segment where higher rates hurts is home buyers, right? Everyone wants a lower rate when they're buying a home. Home prices, have gone up significantly, really since COVID. And so having these slightly higher prices to maybe help stabilize that, I also don't think is a bad thing. And when you think about higher rates, typically that hurts smaller companies the most because they require, they typically have the most debt. They don't get the same types of rates that the larger companies do. And when you look at the market and how small caps have performed, it doesn't seem to have been impacting them. When you look at the IWM up almost 25% this year.
Mm-hmm. No, it's not affecting it. I mean, on real estate too, there's been some interesting discussion online, and there's some people who are in the real estate world who say, look, higher rates have not necessarily hurt. Like, you remember, what is your incentive? So people say the real estate market is a mess. Are they saying that prices have fallen? Or are they saying that the number of transactions has fallen? Because a lot of people make money when there's transactions, like people who do, realtors. So lack of inventory, lack of transactions is not the same as prices falling 50%. And I think because of the inventory things, I mean, prices have held up pretty firm. But with home prices, I mean, definitely the Fed raising rates dampened the appreciation in the home price market. I mean, 100% they got in the way of that. Like, if you lowered rates, you'd see activity start to open up. And I also think that unless there was a flood of inventory, you got to believe that it's not going to be bad for prices. But prices have done just fine with a little bit of inflation. So, all right, let's go to recommendations. I'm going to go to you, Mike, first. What do you got for us?
So I started this movie Pressure over the weekend. It's about World War II and D-Day and the events, some of the events leading up to it. I'm sad to say I fell asleep during it. So right now it's a sell. I'm planning on finishing it, but it sort of felt like, it got good reviews, but to me it just felt like we need another angle at World War II. Let's see what we can come up with.
That's harsh. A sell recommendation. So it's a don't buy. Okay.
For now, I'll finish it and come back and let you know if that changes.
The trader in me would say you should just take the small loss and move on.
Yeah.
But you're going to continue to be wrong, it sounds like.
Yep, I am. I'm going to eat it. Yep.
All right, fair enough. Shane, what do you got?
So completely opposite end of the spectrum. And just fair warning, you were warned, it's extremely raunchy. It's him at his raunchiest. I've seen him in years. But The Hawk on Netflix. It is Will Ferrell. It's a 10-episode mini series about a washed-up golfer trying to get back on the pro tour. And his son is currently on the pro tour, ranked number 1. And it's sort of a comeback story. Lots of just awful Will Ferrell jokes, right? And I told Mike, I think this is the best he's been in a decade at least. Some really funny references too. I don't want to give too many away, but if you know his jokes through the years, SNL, Anchorman, a couple of the other movies, there were some scenes that were almost like nods to those old skits and bits he did too. So I liked it. It's the first thing I've laughed at in a while. So I give it a buy.
Okay. All right. Fair enough. The hawk is a buy. Whatever you just recommended was a sell. I don't even remember the name. I've washed it from my mind, Mike. It's gone. You know what? I haven't watched it yet, and it's not like I'm new to this, but Ted Lasso, the new season's out. Can I just complain once again? Come on, Apple. Just give me all the episodes like Netflix does. Like I look, there's like 2 episodes out. It's like, come on. So I'll probably watch it. I'm on the fence, though, whether they actually should have brought it back or not. I know why they did, because it probably did really well for Apple, and Apple threw a bunch of money at Jason Sudeikis. So I don't blame them for bringing it back. Sometimes when you do this, though, it's not as good. They just should have left it. So I don't know if it's a pre-recommendation or it's a pre-warning. I'm going to watch it, and I'll come back and give my my honest update on it. So, all right, we did it. We got through, and a random Monday one. Maybe we'll play around with the dates we record these. We'll have to talk about that. All right, we'll be back next week to tell you all the stuff we got wrong. Actually, we don't really ever go back and tell you all the stuff we got wrong. We don't tell you the stuff we got right either. So we'll just see you next week then. See you, everyone.